Hi all and welcome back to another edition of Practical Analysis. In this example, I'll be looking at Aussie dollar, US dollar in 1 hourly time frame. So the first thing that we need to do is to confirm the trend. And we can do that by looking at two higher time frames. In our case, 4 hourly and end of day time frame. So let's go to multi-view. Just by looking at daily and 4 hourly time frame, I can immediately see that the price is downtrending. So let's take a closer look. The daily time frame is creating the sequence of lower highs and lower lows. The current price action is falling, capped by multiple moving averages, in our case 20, 50 and 200. In 4 hourly time frame, we can see the sequence of lower highs and lower lows. The price action is currently trading slightly above 20 period moving average, but it's very clearly capped by the sequence of these previous lows at 76.50 level, which also happens to be a 50 period moving average. Additionally, the next level of resistance would be up here at spot 77, which happens to be 200 period moving average. Now, let's go into the actual chart and see if we can identify trend lines, horizontals, or any other evidence which will support the current trend. The current 1 hourly price action appears to be going sideways, maybe even potentially looking to pop out higher. So, in order for us to identify the trend, let's go into a 4 hourly time frame. So, by looking at the 4 hourly time frame price action, we can see that we can connect the sequence of these lower highs by a falling resistance trend line. We can also connect the sequence of these lower lows by a falling support trend line. The 50 period moving average is also a cluster of these previous lows. So therefore we have horizontal resistance at that 76.50. So can we do anything else to additionally confirm the resistance? We can try using Fibonacci retracements. We can identify this significant swing high and extend the price retracement all the way down to this swing low. And the 23% fib retracement is corresponding to the same level, 76.50, which also happens to be the 50 period moving average, and it also happens to be the cluster of these previous lows. The additional levels, which are clearly visible by the use of Fibonacci, are at 77, and if you remember, that's 200 period moving average, followed by 77.60, which is 50% fib retracement from this swing high to this swing low, but also happens to be very close to this falling resistance trend line. Now, let me remove the fibs for now. Just remember the levels. I can try and add an additional indicator. In this case, I can use pivot points. The pivot points, once applied on a chart, are additionally confirming the same or similar levels again. So, we have spot 77, and if you remember, that level was a fib retracement as well, but also happens to be this significant swing low here as well. So, nice and round number, horizontal, fib, and also pivot, and also moving average. So, number of things pointing to that level. Now, let me just remove this for now because I do want you to see the price, otherwise it'll get too cluttered. Above that level, we have 77.60. Yet again, that's a 50% fib retracement and also this falling resistance trend line, and it happens to be resistance 1 in daily pivots. So multiple things are pointing to the same or very similar levels. So what do we do with this information at the moment? If I go into my 1 hourly time frame price action, as a trader, who is looking to trade in the direction of the prevailing trend. It would be logical to assume that 76.50 would be the first level of interest from the bearish point of view. So if the price action spikes into that level and then we get some sort of rejection at that level, that would be a logical area at which some other bearish traders might be looking to find a confirmation to enter into their shorting positions. Another level of interest would be at spot 77. Yet again, horizontal, fib retracement, pivot, and also a round number. And then above that we have 77.60, which is this area up here. So let me just put another area here that could be of interest to us. So what bearish traders are looking to do is they're looking to do something like this. If the price in 1 hourly time frame starts rallying into that 76.50, and then at that point we can see a bearish evening star forming, maybe a shooting star with a big wick above, or a bearish engulfing which has 2 or 3 or 5 small green candles which are then engulfed by a big red candle, a bearish harami, or any other bearish looking candle at that level. They might be looking to initiate their shorts, and if they do so, it's very likely that they would have their stop losses about 15 to 20 points higher, therefore at 77.70. They would also be looking to identify this area here, which is that cluster of the previous lows, as a potential first level at which they might be looking to take some partial profits. But more likely down here at 75.50, where this cluster of the previous lows is, and support 2 in daily pivots. So from the risk to reward point of view, they're risking 20 points with a view to potentially take 100. 5-to-1 risk to reward ratio. Alternatively, if that doesn't happen and then the price breaks above that 76.50, quite often you get a bit of a confirmation from above, previous resistance, now newly found support, and then the price would spike into this next level up here at 77. So what bearish traders are looking to do is they're looking to initiate shorts at 77 again. Bear it in mind, the trend is still down in daily and 4 hourly. So they would be looking to put their stop losses probably about 15 to 20 points higher. So let's say 20, 77.20. And if they do so, they are looking for a bearish candlestick pattern to confirm the entry with the view that price might do something like this. And in that case, they'll be looking to take profits at 76.50, 76, even 75.50. So from risk to reward point of view, they're risking 20 points in order to potentially make 150. Now, there is always alternative. If the price breaks through that 77, quite often you get a small confirmation from above. Something like this could possibly happen. And then the price could possibly spike even higher towards 77.60. At that level, bearish traders are also looking to find a bearish confirmation in a shape of bearish candle, with a view to short at that level, put the stop loss 15 to 20 points higher, with a view to take profits either at 77, 76.50, 76, or possibly 75.50. So from the risk to reward point of view, they'll be willing to risk 20 points up here for a potential 200-point gain. Now, if the price breaks and creates the end of day close above this 77.60, then if you remember, that's our falling resistance trend line in 4 hourly and daily time frames. The bearish scenario no longer makes sense because the trend is changed. So the breakout above 77.60 would no longer support bearish setup, therefore shorting entry. Hopefully you found this example informative and beneficial as well. We've used a different combination of indicators. In this case, we were looking to additionally confirm the same or similar levels by not just moving averages, but also by fibs, also by horizontals, therefore previous highs and lows, and now in this case using daily pivots. We were looking to identify potential turning points by the use of candlestick formations and the patterns, and also the oscillating indicator, which is in our case stochastics. You could use a different combination of things. You could possibly use Bollinger Bands, you could use parabolic SAR, you can use MACD to confirm the momentum and a trend. Instead of stochastic, you can possibly use RSI. It's up to you to try a different combination of indicators that you can find useful and read easily. Hopefully you found this informative, and I'm looking forward to talking to you in our community. Stay safe and happy trading. Hopefully you found those examples useful and are starting to see how analysis and the trading that follows is never perfect. It's about following a process that helps traders find those situations where the odds are slightly tilted in their favor. Let's sum up the lesson next.